Welcome back, financial enthusiasts. Today, we're diving into a fundamental aspect of accounting that forms the backbone of financial accuracy, the trial balance. Whether you're a seasoned accountant, or just starting your journey into the world of finance, understanding the ins and outs of trial balance is crucial. In this video, we'll unravel the mysteries, break down the concepts, and equip you with the knowledge to master the trial balance. So, grab your notebooks and let's balance the books together. This lesson will include the following topics. What is trial balance? Objectives of trial balance. Undetectable errors in trial balance. Reasons for unfavorable balance. What does trial balance include? Example of trial balance. What is trial balance? After all the transactions have been posted from the journal to the ledger, it is a good practice to prepare a trial balance. A trial balance is simply a listing of the ledger accounts along with their respective debit or credit balances. The trial balance is not a formal financial statement, but rather a self-check to determine that debits equal credits. Let's see what are the objectives of trial balance. Preparing a trial balance for a company serves to detect any mathematical errors that have occurred in the double-entry accounting system. If the total debits equal the total credits, the trial balance is considered to be balanced, and there should be no mathematical errors in the ledgers. However, this does not mean that there are no errors in a company's accounting system. For example, transactions classified improperly, or those simply missing from the system, could still be material accounting errors that would not be detected by the trial balance procedure. Errors those are not detectable in trial balance are as under. Error of omission, the transaction was not entered into the system. Error of original entry, the double entry transaction includes the wrong amounts on both sides. Error of reversal, when a double entry transaction was entered with the correct amounts, but the account to be debited is credited and the account to be credited is debited. Principal error, the entered transaction violates the fundamental principles of accounting. For example, the amount entered was correct and the appropriate side was chosen, but the type of an account was wrong, such as expense account instead of liability account. Commission error, the transaction amount is correct, but the account debited or credited is wrong. It is similar to the principal error described above, but commission error is usually a result of oversight, while principal error is due to the lack of knowledge of accounting principles. Do you know about the unfavorable balance? At the end of an accounting period, the accounts of asset, expense, or loss should each have a debit balance, and the accounts of liability, equity, revenue, or gain should each have a credit balance. However, certain accounts of the former type may have also been credited, and certain accounts of the latter type may have also been debited. During the accounting period, when related business transactions reduce their respective account balances. Now let's see, what does a trial balance include? A trial balance includes a list of all general ledger accounts totals. Each account should include an account number, description of the account, and its final debit or credit balance. In addition, it should state the final date of the accounting period for which the report is created. Finally, if some adjusting entries were entered, it must be reflected on a trial balance. In this case, it should show the figures before the adjustment, effect of the adjusting entries, and the balances after the adjustment. Here is an illustration of trial balance for your review. In a trial balance we can write the name of the business on the top of the list, then name of the statement that is, trial balance, then the specified period for which the data included in trial balance. This is the title portion of the statement or this temporary account. A trial balance includes title of accounts, or list of all active accounts on the leftmost column usually. In next column unique reference numbers are recorded in front of each account title. The next two columns are denoted for recording the debit or credit balances, before adjustment of the ledgers in front of each head of account. Then, if some adjusting entries were entered, it must be reflected on a trial balance, Next two columns are used to record debit and credit balance of adjustments such as prepaid rent, depreciation of assets, or bad debts, etc. And then last two columns are denoted for the final debit and credit balances after the adjustment. This is the settled principle that during all stages of the trial balance, total balance of debit and credit must be equal. Thanks for joining us on this journey through the intricacies of the trial balance. Remember, a strong foundation in accounting begins here. In our next video, we'll take it a step further and explore the dynamic world of the income statement. Discover how businesses measure their profitability and understand the financial health of their operations. Hit that subscribe button so you won't miss out on the insights awaiting you in our upcoming video, Demystifying the Income Statement. Until then, keep balancing those accounts and stay financially savvy. See you in the next one.